Exactly. This keeps the balance sheet.
Oh, go for it.
So question number 13. A company which has 50,000 shares at $10 par common stock outstanding declares a 10% stock dividend.
Oh, yeah. Let's hear it.
They declare a 10% stock dividend on December 1st. So on the day of declaration, the stock has a fair market value.
Oh, yeah. Uh-huh.
The stock has a fair market value of $25 per share. So how do you journalize this?
Oh, jumping straight into the numbers for a stock dividend. I love that focus.
Yeah, let's unpack the scenario for question 13 with those 50,000 shares.
So if the company declares a 10% dividend, they are issuing 5,000 new shares.
Since 10% is under that 25% threshold, we call this a small stock dividend.
Right. And the rule for small dividends is that we must use the fair market value.
Now, in our guide, that market value is actually $25.
Oh, yeah. Go on.
Wait, could you repeat that? A small what?
Oh, great catch. I realized I just threw that term small out there without explaining it.
It seems like a value judgment, doesn't it? But in accounting, it's actually a very specific rule.
Right. A stock dividend is officially small if it is 25% or less of the outstanding shares.
Exactly. If it's more than 25%, we call it a large stock dividend and handle it differently.
So because your example is only 10%, it fits perfectly into that small category.
And as we mentioned, for small dividends, we have to use the fair market value of the stock.
Here is where it gets really interesting. In our guide, that fair market value is $25.
So even though the par value is $10, we use that $25 market price for the debit.
Let's unpack the math. 5,000 new shares at $25 each means yep, go on.
So what if it was more than 25%? As in like, and that,
Oh, yeah, uh-huh.
and what, and then, so it's saying like,
Oh, go for it.
so a 10% stock dividend would mean like an additional 10%,
Oh, back to our listener. What's up?
an additional 10% of the outstanding stock.
Exactly, you nailed it. That 10% is based on the 50,000 shares.
So then, like, when this company declares the stock dividend, which is like a property dividend, um, what it does is declares like a certain amount, like a 10% stock dividend. So it will give out like 10% of the outstanding stock as a stock dividend to the stockholders. Um, so that means that if, for example, like 10% of 50,000, 5,000 shares would be distributed to the stockholders based off of how many shares each stockholder owns. But then because it's a small dividend distribution, instead of using the par value, use the fair market value. So the amount of dividends, the worth of dividends is 125,000. So then, like the journal entry to record the dividend when it's declared would most likely be like this. Retained earnings and the stock dividend table.
Already out there.
It's basically
Hey, yeah, what's up?
Sorry, why is it a distributable again?
That is a great question. We use distributable because the shares haven't been handed out yet.
Okay, let's unpack this. It is basically a temporary placeholder on the books.
Exactly. Since we are not paying cash, it is not a liability like that dividend payable we discussed.
Right, the company is just promising to give you more pieces of the same pie later.
So
Oh, yeah, uh-huh.
Like so like if it wasn't any other stock if it was any other dividend pay, it should be a distribute. It should be a dividend payable, but this one is distributable for what reason?
Okay, let's unpack this. It's a subtle but really huge distinction in accounting logic.
Exactly. If we called it a payable, it would show up as a liability, like a debt.
But the company doesn't actually owe you any cash or assets in this specific scenario.
Right. Common stock dividend distributable stays in the stockholder's equity section, not the liability section.
So it's like a coming soon sign for your new shares within the equity family.
Precisely. It wouldn't make sense to call it a liability because no assets are leaving the building.
That makes total sense. You're just moving value from one equity pocket to another.
So when the company finally issues those shares, they clear that distributable account.
They move that $50,000 into the permanent common stock account.
That takes care of the car. Yeah.
Oh, so like you're saying like dividend payable would be a liability, but common stock dividend distributable is equity?
Bingo, you've got it exactly right. It is a huge distinction.
Oh yeah, let's hear it.
So then on the date of distribution, what would the journal entry look like?
Exactly. It is a huge distinction that changes everything about where the numbers live.
Right, and to answer your question about the distribution date, that's when the coming soon sign comes down.
Okay, let's unpack this. When those shares actually go out, we have to clear that distributable account.
Precisely. On that day, you debit the common stock dividend distributable account for the $50,000.
So we're basically wiping out that placeholder we talked about earlier.
Exactly. And then we credit common stock for that same $50,000 par value.
So what does this all mean for that leftover $75,000 you mentioned?
Well, what's fascinating here is that the $75,000 was already handled on the declaration date.
Right, because we did that big debit to retained earnings for the full $125,000.
Exactly. Since we only credited the distributable account for par, we needed a balance right away.
Here's where it gets really interesting. We use that plug figure to bridge the gap immediately.
We credited paid-in capital in excess of par for that remaining $75,000 on day one.
So on the actual distribution day, we are really just moving par value into its permanent home.
Spot on. That distinction is the bedrock of understanding why we treat these dividends as internal moves.
Because nothing ever leaves the building, it all stays inside that stockholder's equity family.
Precisely. We are just reclassifying where that value sits.
Oh, go for it.
So is the issue date the same as the okay?
Oh yeah, let's hear it.
But then what happens to the paid-in capital in excess of par? It's uncredited.
That is a great question, and the answer is actually quite simple. Nothing happens to it.
Wait, really? So it just stays there after the big distribution day?
Exactly. It was recorded on the declaration date and stays as a permanent part. Oh, yeah.
But is it paid-in capital excess of par? That's a contra account, isn't it? Like what kind of contra account is that? Like equity?
I love that you are digging into the specific types of accounts. It shows you are really tracking.
It is an excellent question. To clarify, paid-in capital in excess of par is definitely not a contra account.
Right. It is actually the opposite. It is a permanent increase to the company's value on the books.
Exactly. A contra account, like treasury stock, works against the main balance to lower the total.
But
Oh, yeah. Go on.
So then the paid-in capital in excess of par would decrease the what? The retained earnings?
You've got it. When we credit paid-in capital, the offset is indeed that debit to retained earnings.
okay, let's unpack this. So retained earnings definitely goes down to fund